but it's a very interesting pattern to look at. And if that's the case, it's signaling that after this move down, because history was made a couple of weeks ago, we broke $2,200 per ounce, $2,300 per ounce. I would never thought we would see that this early in the year. And 10 years ago, if you had asked me, I would probably say we'll never see that. But nonetheless, we're there. We've softened a bit. Depending on what happens over the next day or so, will determine whether or not we see gold really reignite, move to the upside, or continue to move lower, because it is going to hinge on the Federal Reserve.
The recent Federal Open Market Committee meeting concluded with the Federal Reserve maintaining its monetary policy, as anticipated. The key Fed funds interest rate range remained unchanged at 5.25% to 5.50%. Post-meeting, traders have adjusted their expectations, with a 73% chance now priced in for a rate cut in June, up from the 65% chance seen before the Fed's decision. GaryWagner, editor of thegoldforecast.com, highlights the significance of upcoming events, particularly the Federal Reserve's decisions and statements, in shaping the direction of gold's next move. In U.S. trading on Wednesday, gold and silver prices surged closer to daily highs following the Federal Reserve's monetary policy statement, which was perceived as favorable by precious metals bulls. The persistent demand for safe haven assets, central bank purchases, and ongoing geopolitical tensions continue to bolster gold prices. Gold, a traditional hedge against inflation, tends to attract investment during periods of lower interest rates, as it does not yield interest like other assets. Last week, gold prices experienced a slight dip of nearly 1% after February's macroeconomic data revealed higher than expected inflation, dampening hopes for rate cuts. According to recent price action, Wagner's analysis identifies a critical support level for gold around $2,150. Should the price approaches this level, he anticipates potential resistance to further downtrends as buyers are expected to intervene. Following the U.S. Federal Reserve's indication of a potential reduction in interest rates by 0.75 percentage point by the end of 2024, gold surged over 1% on Wednesday, prompting declines in the dollar and Treasury yields. Join us as we delve into insights shared by GaryWagner. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
It's called an intraday chart. I typically use dailies, but each candlestick here represents 4 hours of trading, and it's divided, obviously, into a 24-hour period. And the reason for that is you can't see it in the daily, but in the 4-hour, we have what's called a bull flag. You've got your flagpole here, the straight line up, and then you use two parallel lines. The idea is that it zigs from the top, from the highs to the lows, highs to the lows, and it breaks to the upside when it's in this formation. Now, whether or not it pans out like that will depend on the fundamentals that move the market, but it's a very interesting pattern to look at. And if that's the case, it's signaling that after this move down, because history was made a couple of weeks ago, we broke $2,200 per ounce, $2,300 per ounce. I would never thought we would see that this early in the year. And 10 years ago, if you had asked me, I would probably say we'll never see that. But nonetheless, we're there. We've softened a bit. And depending on what happens over the next day or so, will determine whether or not we see gold really reignite, move to the upside, or continue to move lower, because it is going to hinge on the Federal Reserve. They are. I think that what we're seeing is the fact that gold has always been a hedge against inflation. And the way that you want to look at it is buying power. Inflation really means what your dollar can buy you, or your yen, or whatever currency you're looking at. And if you consider the buying power of gold 10 years ago, or 20 years, or 100 years ago, and the buying power now, you can pretty much buy the same thing for the same amount of gold, but the currencies have devalued tremendously ever since we went to a fiat currency system worldwide. We have really strong, what I'm calling, support near the lows that we had just recently, which is right around 2150. And the reason I peg that, now for this chart, I'm going to have to really go ahead and compress it to get to that area. Yeah, if you bear with me, that's this rectangle here. if you recall, we had an interesting leg up to where we are now, in which on Friday it went to an all-time new price high, and then it spiked up. This right here represents 2152, and by Monday morning, close of New York Monday, excuse me, it was way back down. And when I say way back down, it was down to about 2090. So this to me is what I've been labeling as a key level of support, just because the way a market technician looks at support and resistance is tops and bottoms, also Fibonacci retracement, but tops and bottoms are very accurate ways of determining support and resistance. The other thing that's good to know if you're learning about technical analysis is that support and resistance are part and parcel of the same thing, meaning that an area can be resistance, meaning as the market goes up, it hits it, it's going to come down. But if it breaks through, it then becomes the floor or support. So the same price point can act as support or resistance.
Silver prices declined for the third consecutive session, trading lower around $24.90 per troy ounce. The market's cautious stance ahead of the Federal Reserve interest rate decision has posed challenges for silver. GaryWagner highlighted a significant support level of around $25 per ounce. If the price reaches this level, it could challenge the recent December high, which is around $26. He also mentioned that the possibility of a further decline of $25 doesn't hold, with the price potentially slipping to $24.25. Despite the downward pressure on silver prices, geopolitical tensions, and an improved industrial outlook from China, the leading metals consumer, could support silver. Inflationary pressures in the United States prompted a reassessment of the likelihood of interest rate cuts in the June and July meetings by the Fed. The anticipation of higher interest rates has diminished the attractiveness of non-yielding assets like silver in the eyes of investors. Let's get back to the interview.
Well, right now we've had 2 days of sell-offs. I personally think that major support comes in at around $25. I'm looking at June futures currently at, say, $25.33. And so if it doesn't hold $25, it could slip lower. But I'm looking for it to actually challenge this recent, these are what's called a real body. The wick is the difference between the relationship of the open and close, which is how you create something in a candlestick. And this is the actual high that we had back in December of last year. So I think in terms of room to grow, it could easily move to higher areas, 26 and beyond, if the trend continues. If not, support at 24.25. Well, the biggest thing that I've noticed over a medium to long-term period of time is a decoupling of the tandem nature that, as I grew into being a trader, was there. In other words, gold moved up, silver moved up, gold moved down, silver moved down. The key difference was during a rally, silver would outperform gold in terms of percentage gains. The same with a correction. When they were both going down, silver would overperform or have a larger percentage drawdown. But they moved in tandem. That has, I call it a decoupling, because there are now days where I will see silver trade higher and gold lower, or vice versa. And that's something that we didn't see, say, 5 years ago or 10 years ago.
Is this a sustainable run on copper? I mean, it seems like it's not going anywhere. People need copper.
Well, I would have to say it's gone quite far. When you consider in February, it was trading at around $700 per pound. Copper is sold in pounds in terms of the contracts. It then went to a high of 768. But look at the move today, a tremendous move from opening above 764 to its current pricing, which is about 756. So it's declined by about $8 per pound today.
Is this just a correction?
It could signal a correction. It's either going to be, technicians are funny in that we have an answer on both sides. It's not that we're trying to balance our bets, although what we are trying to do is anticipate either way it could move. This could be what we call a one-off or a one and done. That does happen if there's a true demand supply imbalance. Then it quickly corrects itself if what's happening is the demand is exceeding the supply. Then even if it sells out off, it will quickly move back to the upside. Right now, support 754, it's just above there. If it corrects, it could go to 745 per pound. And these are just the numbers that I'm working off of, which is the 23.6% fib retracement and the 38.2.
How do you interpret the recent adjustments in traders' expectations, particularly the increased likelihood of a rate cut in June following the Federal Reserve's decision to maintain its monetary policy? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.